Well, greetings, my beloved clients and friends. So in the last video, we made a comment along the lines of if an investment generates an income, it has a value. And there's a way to estimate that value based on the income. And I left it at that, and I wanted to expand on that so that um, you can understand what we do in the office. So, not all investments generate income. Okay, like gold does not generate an income. Bitcoin does not generate an income. But some investments do generate an income. A bond generates an income called dividend, and a real estate generates an income called rent, and businesses generate an income called profits, okay, or earnings, or cash flow, or also dividends. Those are all forms of income that a business can generate. And so if that income is consistent and it's not, is it consistent or not? There's like a spectrum, if you will, of extremely consistent to not consistent at all. And different investments will lie along that spectrum. But to the degree that the income from that investment is consistent, you can estimate its value. Okay? And it has value because investors are looking for income. Okay? So, and one way you could define or describe that income would be an interest rate. So, let's say an investor walks into a bank and he says, what are your 1-year CDs paying? And the banker says 3%. He goes, okay, thank you. And he goes to the bank across the street and he asks the same question. What are your 1-year CDs paying? And the guy says 4%. So which one would he prefer? All else held constant, if both banks are of comparable quality, well, he'd take the 4% CD, right? And some people used to do that back in the day, and maybe they're starting to do it again now that rates are up, is shop around all the banks in town to see where they get the best interest rate, and they put their money there when their CDs come due. So that interest rate is a representation of the income. What that means is, if you invest $100,000 and the interest rate is 3%, it's going to give you $3,000 a year. Or 3 divided by 100 is 3%. The other one, if you invest $100,000, it's going to pay you $4,000 a year. Or 4,000 divided by 100,000 is 4%. So that's a way to calculate the income that generates. So investors are shopping the globe for income. And if you had a $400,000 house and you could rent it for let's say $2,500 a month, that would be $30,000 in income. But if you had to pay property tax and HOA and maintenance and insurance and all that was $10,000 a year, then your $30,000 rent minus your $10,000 expenses is $20,000. That's your net income on that. And so if you paid $400,000 and you got $20,000 in income, that would be a 5% income. And an investor might prefer that over a 3% CD or a 4% CD, right? And then he saw a business, let's say a stock, which is shares in a company. And this company was trading at a market cap of $100 billion. But it had free cash flow of $6 billion. Okay, after all its expenses, it had free cash flow of $6 billion. And they say that I'm paying $100 billion for this $6 billion of free cash flow per year. And it's been very consistent, and maybe it's even growing. Well, they might prefer that, because that would represent a 6% interest rate. They might prefer that to a 3% CD or a 4% CD or this 5% rental property, right? So anything that has an income has a value, and there's a market for that asset. And let's say something came out and it also had consistent income. Let's say it was this $100 billion company with very consistent income, and that income was $10 billion and its market cap was $100 billion. That'd be a 10% interest rate. It would compare very favorably to a 3% CD or a 4% CD or a 5% rental property or a 6% stock in a company, right? So what would happen? Money would tend to move towards that, and it would be priced down to where it was probably yielding close to everything else. Okay. So if you look at the income and you consider, a more consistent income or more safe or almost maybe even guaranteed income is not going to have to offer such a high rate, right? If it's super safe but it's 3, maybe someone might prefer that to a less safe 4 or 5, right? So there's preferences. Or let's say there's a 4 that's not growing versus a 3 that is growing. Someone might prefer that. So there's preferences, and there's nuance to the value of these, but there's a general value or there's a general estimate of value, and you could, discount certain things or give it more credit for certain things and kind of come up with an estimate of the value. It's not going to be to the penny or even to the dollar, but you have an idea of the value based on the income. Now, what about something that generates no income? It's hard to determine the value, and really hard is an understatement. Probably impossible is more accurate, and people could just take shots in the dark. And that's why those types of investments that do not generate any current income tend to fluctuate wildly, because the value of it is so uncertain. The more certain the value, the less it tends to fluctuate. And sometimes the less opportunity, because it's easier knowable. But so if we study the income and get a good understanding of how a company generates an income, how much we're paying for that income, and how that company grows its income, we could come up with a reasonable estimate of its value. And once we do that, we can compare that to the price that we could currently buy it for. And we could determine, wow, that price is a little too much, or a lot too much, or fair, or looks like a decent discount, or it looks like a great opportunity, right? Um, so what if the price of a certain investment starts going up a lot, starts having this big run, and it's up 50% year to date, let's say, but the income hasn't changed? The price is moving and the income is not moving. That's probably going to come back down to reality, right? It's just hype, it's just excitement, and unless the income starts to catch up to the price, more than likely the price will come back down to the income. Okay, so but what if the income's going up and the price is not? Then that could represent an opportunity, right? So and the price and the value kind of have this dance. The value tends to be more steady, and the price is all over the place. It's like Latin dance. That's how it is. The man is the lead, and he stands in the middle, and he twirls the woman all around, right? And she's moving all over, and her dress is flowing and looks very attractive and catches the eye. But the man's very steady. So that's like the value. And the price is all over the place. But, you know, the price doesn't deviate from the value for long. Eventually it's going to come back to that starting position, right? So, or like a flag and a flagpole. The flag is waving all over the place, but the flagpole is steady. That's the value, and the price is all over the place. So we study the value and try to, so we don't look at charts of prices so much all day in the office. We look at the spreadsheet of the income statement and the balance sheet and the cash flow statement, and what the CEO and CFO are talking about, the direction of the business, to determine the value. And then if it appears that the company is of good quality and the income is of good quality and seems to be going up, then we say this is the type of company we would like to own. The third thing after we determine the quality and the value is then we ask, well, what's the price? And if the price is attractive, we might buy it. But we don't start by looking at the price. We start by looking at the quality, then the value. And so a company we recently bought was United Healthcare. And the quality of its financial statements and the quality of its income looked very good. And it was going up. The income was consistently going up about 15% a year. They were raising their dividend about 15% a year. They didn't have a lot of debt. They had good cash, and there were some things that were in their favor that maybe weren't going to be in their favor for long. For example, during COVID, people were paying their premiums, but they were scared to go to the hospital because there was a lot of sick people, right? So they were collecting premiums and not having to do a lot of surgeries. So that was in their favor, right? And now they were saying, you know what? Now that COVID is behind us, more people are coming in to do their surgery. So we're going to have to do them. That's going to affect our expenses because there's kind of like a 2-year backlog of surgeries. So we took that into consideration. And, but even with that, it seemed like, you know, their income was great, their expenses were down, and they gave us an estimate that said, this is about how much we anticipate it's going to impact our expenses because we have to do more surgeries and really collecting the same premiums, you know. So factoring all that in, the quality still looked good, and because they made that announcement, the price had come down. And it seemed to us that maybe they got beat up more than they needed to, and it reflected a buying opportunity. because they're going to continue to grow their income over time. And or I mean, that's not a fact. That's in the future. That's an estimate of what we believe will happen. But it looked like a really good quality company at a decent value, and prospects for growing their income over time, and it paid a good dividend, and so it met all our criteria, so we bought it. There was another company that we looked at called Norwegian Cruise Lines, and it appeared to be an attractive value, but the quality wasn't as good. So if all you look at is the value and you don't look at the quality, you could get into trouble too. So now it may turn out that investment will work out, because there was some upside. It seemed like it was still trading at a big value. So, you know, if the risk that we saw because of lack of quality did not materialize, it could turn out to be a good investment. But it was more risk than we wanted to take. So it may turn out to be good, but it didn't meet our risk profile. So, but because we looked at the quality first, well, actually, we were attracted by the value. We kind of said, okay, wait, before we get excited about the value, let's look at the quality. And we saw some things we didn't like in terms of the quality. So that was when we passed on, and it may turn out to be a good investment, but we didn't want to take the risk. So it's really important, and we just want to let you know that we look at the value, and we don't get swayed too much by the price movements. And I think that's important. And I know you're at a disadvantage because you don't have a detailed, maybe in many cases you don't have a detailed, like the statements don't tell you the company's income. All they tell you is the price. So if all you're looking at is the price, you could get kind of maybe too excited when it's up, or too pessimistic when it's down, or not understand why we sold it when the price was going up, or that type of thing, because you're not, unless you do your own independent research, you're not really privy to what's going on with the income of that company. All the statements show you is the price. And so I understand that disadvantage you have, but we just want to let you know we're not just looking at the price. We are also looking at the value, and that's sometimes why we hold on to things when they've come down, or sell them when they've gone up, or make the moves that we do, because we're watching primarily we're looking at the value. So I hope that gives you some insight into how we manage your money, and hope that gives you a certain level of comfort. That we're sitting there with our green visor and looking over boring spreadsheets that we particularly find fascinating, and we're not just reading charts and drawing squiggly lines on a price chart. Okay, hope you guys have a great day.